My name is Steve Weil, and I am President and Tax Manager of RMS Accounting. And the reason for this presentation is we have been receiving more and more questions from real estate investors and owners of rental property, especially with the pandemic and the inability to collect rent. We will be dealing with the tax consequences of changes in the tax law and lost revenue due to the pandemic. We worked with lots of landlords and folks over the years, helping them to deal with tax problems and the complexity of the tax code. Sit back, relax. We're going to give you a lot of really great information. Okay, so what are we going to talk about today? Well, in an overview, we're going to talk about the forms of ownership that you can have real estate in and the pros and cons of each. We'll talk about real estate activities, what's an investment activity, what's a rental activity, and what's the difference. We're going to talk about rental income and expenses and give you a good idea of the kinds of expenses that are going to show up on your tax return and how you should track those. We'll also talk about limitations on losses. Real estate is considered a passive activity, and there are rules on the deducting of losses from rental real estate activities against other income that you may have. We're going to touch on the QBID, which is the Qualified Business Income Deduction. Relatively new to the tax code. This will be our second year with the QBID, and we've got a little more rules and some safe harbors that will allow you this wonderful deduction. This is the first time in history that I remember where you could take a tax deduction and not have to actually spend money. So there's a way to reduce qualifying income by 20% just by filling out the form and meeting the guidelines to qualify you. And it's really an important deduction if you have profits from your rental real estate activities, and making sure that you protect this deduction is important as well. Now, that QBID deduction is good for all kinds of businesses, but like all things from the government, there's all kinds of rules that go with it. In addition, we're going to talk about the taxes on sale of a real estate property, whether it was a rental or whether it was an investment property, or what kind of property it was, or whether you're a dealer, and we'll talk about some of those terms. So let's get started, and let's get started with ownership forms, because there's all sorts of misinformation in this area. If you own a property in your individual name, it's titled to you as an individual, okay, the tax reporting on that is done on Schedule E, and it just becomes part of your 1040 tax return. And there's no separation between you and the property for both liability and income purposes. If you own a property with a wife, spouse, friend, roommate, another investor, then by default, when more than one person own a property, that ownership form takes the form of a partnership. So more than one person, it's a partnership. And in most circumstances, that requires the filing of a partnership return, Form 1065. Now, the good news here is Form 1065 is nothing more than an information report. It reports the income and expenses and then passes that net income and expenses on to the individual owners in proportion to their ownership on Schedule K1. Again, if you're a partner, then you're liable for all of the debts of a partner, typically, and the debts of the partnership. If something happens on the property and they sue, they're going to sue you. You're an owner, and there's no liability protection for taxes. This passes through that the same way that income would eventually show up on your sole proprietorship. It's just a little different form that it comes through on, and then a little different place on Schedule E. But you have to file a partnership, and failure to file a partnership return can result in substantial penalties. So you're not just supposed to break the property down the middle and each takes your half. There is an exception to that, and we'll talk about that a little bit. It's a qualified joint venture, but the exception only applies to husbands and wives that own the property together. If a married couple owns the property together, it can be reported without the partnership return on their individual return if it meets the qualifications for a qualified joint venture. If you're worried because you're in a partnership and you haven't filed the partnership return, there is a way around the penalties for partnerships that fail to file. Unfortunately, the out here means that all of the partners must be domestic partners, in other words, U.S. partners, and they all have to file their tax returns on time, and they all have to pay their taxes on time. Now, as a representative in the tax world, the last thing I want to do is fight a penalty by proving that all of the partners filed and paid their tax on time. They usually don't know that much about each other and certainly can't be guaranteed that the other partners filed correctly and on time, but it can be an out if the partnership penalty is assessed for a domestic partnership with less than 10 partners. If you formed an LLC, and LLCs are entities formed with the state, and they can be formed in most states these days, but if you formed an LLC, that entity is invisible to the federal government. Federal government pretends it doesn't exist, and they go back to what is really happening here. If you formed an LLC and you put your property into an LLC and you own 100% of the LLC, it's going to be ignored for tax purposes. And it's going to be filed on Schedule E on your individual return. And the benefit here is that the LLC could end up giving you substantial liability protection, not from the federal government or taxes, but if somebody falls on that property, if somebody gets hurt, if somebody sues for that property, that lawsuit theoretically stops. You limit your liability to the assets that are held in the LLC. Now, if there are 2 people or 3 people or more who own part of the LLC, then it is a partnership and it has to file a partnership return. Again, it protects all of these owners from liability from things that happen in the LLC, but it does not have any effect for tax purposes. A lot of times I'll hear clients talking about their attorney or somebody told them to put their property in an LLC. That can be a good idea to separate the liability so that if something happens on your property, somebody gets hurt, they fall off the 3rd floor balcony and they're injured, and they sue for more than the amount of your insurance, that they can't come after you personally or any of your personal assets. So that could be great, but it is not. Some of my clients come to me and say, well, I was told then I don't need insurance on my property in case somebody sues me. And the problem is you have to defend the lawsuit. You have to put the claim forward that you're not personally responsible. And all of that stuff requires attorneys and costs money. And after all, that's a big part of what your insurance pays for, is the defense costs when something happens. While you could protect other assets, and it's great for protecting other assets, thinking that that means nobody can sue you and get anything, you just need to understand that you need to be prepared to defend the lawsuit and to defend the fact that you are an LLC, and hence the liability shouldn't pass out of the LLC. And of course, you need to keep the right books and records to support that. You can have property owned in a corporation. Now, we usually do not like to put real property into corporations. And in most cases, if you're running a rental property, if you put it in a C Corp, you're going to create double taxation, probably not the best thing in the world. If you put it in an S Corp and you have gains on it and you take out too much money, you're going to create a capital gain circumstance that creates taxable income and does not have any actual regular income if it wasn't in that S Corp. But there are times when it may make sense to use one of these entities. I sometimes have foreign investors investing in property in the US, and they are not looking to ever repatriate the money or the profit from that rental property to their home country. They don't want to report the income in their home country for one reason or another. So they might want to put the property into a C corporation and that would allow the corporation to pay the income tax, the money to stay in the property, them to invest in additional properties, and they're using it as a safe harbor so that if something goes wrong in their home country and they have to come to the US and they can't bring any other assets for some reason, they now have this business that's operating rental properties in the US that has built-in gains, and while it may pay a little more in tax, the fact that there's money there is more important than the fact that they didn't save on the taxes that they paid or had to pay extra tax on it. So there are times when your attorney or accountant may advise you that it makes sense to use a corporation, but those are typically the exception. The other time that it sometimes comes in is if the property is really a part of the business and is necessary for the business and should be included in the corporation or entity that's operating the business. And there are times it makes sense to separate the property out and in effect create a self-rental. And there are times that it makes sense to move the property in with the other activities, especially because of the QBID benefit and some other things that you can do. And of course, no discussion of entities would be complete without talking about the Florida Land Trust. A Florida Land Trust is an entity that can be used to own property, much like an LLC. It is invisible as long as the person who set it up, funded it, and benefits from it is alive. It's like a revocable trust where it's invisible and the income is reported on your personal return. However, upon death of the principal owner, the Florida Land Trust has to file a 1041 or a trust return for its income when it's no longer a revocable trust. The benefits of a Florida Land Trust, you can talk to your attorneys, but if somebody's interested in purchasing your property without retitling it, that can be done fairly simply by transferring the Florida Land Trust. Not a lot of tax advantages while you're alive. After your death, it creates a little more hassle in dealing with the 1041, but your estate probably would have done that anyway. But it is a vehicle that we see used in Florida for holding the title of the property when people don't necessarily want their name showing up on the title, when people want the title to be easily transferred without going down and filing changes of deed and changes of ownership. You can just change the owner of the Florida Land Trust. So don't see a lot of them anymore as often, but it is still out there and we want to make you aware of it. Let's talk a little bit about the pros and cons of each. First of all, individual, the liability, you have no limits on liability. I fall off the roof on your 3-unit building while I'm repairing the roof, or my tenant's child falls off through the balcony. All those things, when they sue, they can not only sue the property, but they're suing you personally. The same is true with a partnership. They're going to come after the assets of the partners. In most cases, there's no limit to the liability. You may have protected assets in Florida, assets like money in IRAs, pensions and annuities, or your principal residence, your homestead property, but any other assets you have are open to cover any liabilities from the property. In a limited liability company, that's just not true. Assuming you do things right and run your limited liability company or LLC correctly, they can sue for the value of what's in, which might just be the equity on your one real estate investment, but they can't come after assets outside. So if I have a triplex in one LLC and I have a warehouse in another, somebody does something at the triplex, their lawsuit can't extend to the value of my other LLC that holds the warehouse. There's some great liability protection there. This is also true for a corporation and S corporation, and a Florida Land Trust may also have liability protection. So when you're thinking about liability protection, these are great topics to discuss with your attorney. Don't just, use the attorney to fill out the closing documents. A great time to get advice on what type of liability you are creating. Ease of transfer. Well, that's a pro for an individual. You sign a deed to somebody else, it's very easy. Property in a partnership, typically if the partnership is selling it, it's going to require the partners all to sign off on it. So even though I only own 10%, I may be required to sign off. It may make it harder to transfer the property. It's something you ought to talk to your attorney about, but we have seen where closings have been delayed because partners disagree, and it can slow things down. A limited liability company, it's also a con. The limited liability company's got it. It's a little more complex, got to sign off on it. The same, there's some more paperwork in an S corporation. A Florida land trust is very easy to transfer. That's what they were designed for. You transfer the ownership to the trust as opposed to the property, which works great until the new person wants to depreciate, and there may be some things in there depending on how that's transferred. That's also an issue with a corporation S corporation. You can't just transfer the entity. People don't want to buy them because they A, don't want the liabilities, and B, they want to start depreciating the property all over. There are separate tax returns for individuals. No, it's just a schedule. It goes in your tax return, makes it very easy and much less expensive to do the tax work for property that's owned individually. When a property is owned in a partnership, unless it's a husband and wife qualify, it requires a partnership return. This is a little more complicated return to do, a little more another expense to go out. If it's a qualifying joint venture, we can skip that step, but in most cases it is. Limited liability companies with only one owner or member are treated as sole proprietors and filed on the individual return Schedule C. However, when there are two or more members or partners, a partnership return must be filed. S corporations and C corporations also require the filing of a separate return. Florida land trusts only have it as a con once the primary owner has died and they're no longer revocable. And of course, it's very easy for individuals to borrow. It becomes more complex when a partnership is trying to borrow. LLC is treated just like a partnership. Corporations, of course, it's even harder to borrow in most cases. It might be a problem to get financing on a Florida land trust property as well. Banks are just not as familiar as they should be with these entities. There are tax advantages to in an individual, a partnership, or even a limited liability company, because remember, it is taxed as a partnership. It can cost you more in taxes in a C Corp. It will cost you more because you'll pay tax at the corporate level, and then if you distribute any money, you'll pay tax again at the individual level. The bite is not as bad as it used to be with the lower corporate tax rates, but if you know what's going to happen in the next 4 years, you let me know. I get a feeling that the lower corporate tax rates may be a distant memory by the end of 4 years. But I don't know that, and neither do you at this point. It kind of depends. In an S Corp, if you have distributions that exceed your basis, the capital you put in plus the profits, I borrow money and I take out some of the money I borrow, it can create capital gains even when there's no actual gain. Those are things to think about. Each ownership device has pros and cons when you're talking about forms of ownership, and it's a good thing to run by your attorney and legal counsel. This brings us to the end of part 1 of our 4-part presentation. Please stay tuned for the other 3 parts and more great information for real estate, rental, and investment professionals. Thank you, and have a great day.